So today we're going to go over key ratios and financial analysis. EFI was able to put on a presentation recently on key ratios and financial analysis, and this will be kind of like a little bit of a preview of that presentation. And those who are interested can contact us in regards to presenting for a group or a convention or just to corporate customers. So the key thing here on key ratio analysis and the agenda that we just talked about was financial statements, the type of businesses that can be formed, their financial statements that are defined, basically cash conversion cycle, and then the ratio analysis in particular. Couple of the ratios that we look at, there are the key factors that we look at were liquidity, asset management, debt management, which is the leverage, profitability, and then we also did a case study as well on the steel industry. The next item we covered were ratios and profitability, evaluation of cash flows, sources and uses of funds, trend analysis, and the types of credit. Also terms and open account. And so here are the goals for financial statements that we had set up for this meeting, and then also for imparting more background onto what users should look for in financial statements. The first one is what does the ratio tell us about a specific area of the company? So when you're looking at a company, you want to be able to know, what the goings on are inside the company, and the ratios help us delve deeper into that and find out what we're looking for. Second item is what are the trends that are noticeable through the financial analysis of the company? Is the company improving their overall financial picture, or is it getting worse? Obviously, if it's getting worse, as a creditor, banker, or even executive management, what do we need to do to change that to make it better and to right the ship, so to speak? The next one is what is the difference, what correlations from one ratio to another, or how do they correlate? Does this help the creditor or loan officer in extending credit or making a loan? Obviously, you want stronger ratios on most everything, and so which ratios, after you've done your trend analysis, which ratios are better and which ones are worse, and which ones are the weakest. So those were kind of some of the goals that we set out for this presentation as to where we wanted to go for the users of the financial statements. The ratio analysis, they're going to go through each kind of one that we went through specifically. The first one we talked about was liquidity, which includes the current ratio and the quick ratio. The next was asset management, DSO, DIO, DPO, and fixed asset turnover. We explained those in depth and went through each one of those as well. Debt management or leverage. What is the debt ratio? How does it calculated? What does it mean? That type of thing. The debt to equity ratio and the times interest earned, obviously. And then the last one was profitability and the gross profit margin and net profit margins. How are they calculated? What do they mean by industry? Return on equity and return on investment. And those were the things that we look for in the ratios and help us analyze liquidity, asset and debt management, and profitability. Finally, the C's of credit that we covered as well. The first one was character. The second one was capital. The third, capacity. The fourth, conditions. And fifth, collateral. And finally, the cash flow and coverage. So that basically wraps up the summary of what we covered in our recent webinar. And there's the contact information if you're interested. Love to discuss more with you. So thanks so much for listening and have a great day.